Gavin here from Behind the Money. Today, I'm going to debunk diversification. If you spent more than 10 minutes reading about how to build your portfolio, you've probably heard that diversification is the most guaranteed way to grow your money.
The possibility of one really bad stock hurting your nest egg even as early as in your 20s is simply too risky for this guy. With an index fund, no one stock or even sector can do that to you.
No. For the sake of argument, let's say you can compound your money by 8% annually through investing it in a broad market ETF. If you don't already know, an ETF is an exchange-traded fund. Basically, someone else picked 100 or so stocks that they liked and put it into a basket. By investing into the ETF, you're investing into that basket, and thus you're indirectly invested into all the stocks that they are. There are ETFs for tech stocks, Canadian stocks, American stocks, Brazilian stocks, large cap, small cap, anything you can imagine. So, compounding at 8% a year. If you started with $5,000, after 10 years you're going to get $10,000, and after 30 years you're going to get $50,000. I'm not saying that's not a lot of money, but that's not our goal. Let's put this into perspective. If you instead compounded your money at 30% annually for 10 years, you're going to have $68K, and if you did that for 30 years, you're going to have $13 million. Now, if you did it at 40% annually, you're going to have $40 million. Let's take a look at concentrated portfolios. Consider this analogy. You're a small town investor and you've been given $1 million. Your goal is to grow it by investing into local businesses. There are about 1 to 200 local businesses in your community. What do? Chances are, you're going to pick the best businesses in town. Out of the 1 to 200, you can probably identify the top 50 easily. The movie theater, the gas station, the corner store. From those top 50, you can probably narrow it down to 8 to 10 that have good management, growth prospects, and balance sheets. And then, you'd invest your money. Sit back, watch it grow, and live your life. It makes sense, right? But when it comes to stocks, people are throwing their money at the 50 or the 100 or the 200 evenly. Why? It doesn't make sense. Why would you split your money across the 200 businesses when you can invest in the best 8 to 10 and make the most money? You don't have to take my word for it. In fact, don't. In the description, I've included a few links to some studies that explore the merits of portfolio concentration. I could discuss them in this video, and I might do that in a future one, but I think it makes sense for you to see it for yourself. So why are people still so focused on diversification when it doesn't make sense? The answer is fear. People get crazy and illogical when it comes to their money. Their fear of losing is holding them back from winning. Think about a small town. If you weren't investing someone else's money and it was your life savings, you might start thinking that spreading it across 80 or so businesses is a safer way to not lose it all. But this doesn't always make sense. Think about it. In the event of an economic disaster, the weak businesses are the ones that are going to die, and the strong businesses are the ones that are going to survive and emerge even stronger. Survival of the fittest. That's how the world's always worked. So you get it. Diversification isn't all it's cut out to be. Or is it? Warren Buffett, one of the most successful and proven investors over the past 60 years, had this to say about diversification.
We think diversification is, as practiced generally, makes very little sense for anyone that knows what they're doing. Diversification is a protection against ignorance. If you know how to analyze businesses and value businesses, it's crazy to own 50 stocks or 40 stocks or 30 stocks probably.
What he's saying is that much of what is taught in modern corporate finance courses is twaddle.
On the surface, it sounds like he's saying diversification is for idiots, but that's not quite true. He's making the point that if you don't know a lot about investment, which, let's be real, your average Joe doesn't, diversification can make a lot of sense for you. Let's revisit our small town analogy. Let's say your town is known for its cemeteries. You want to get in on the action. You don't really understand how the cemetery business works, but you have some intuition that it's going to do well soon. So what do? You might split your money across 20 to 30 businesses. You're taking a bet on the industry as a whole, and this might make sense. You're not going to make as much money as if you pick the top 4 or 5 businesses, but given what you knew, you're going to make some money. Now, some of you might say that investing in one industry isn't diversification. It is and it isn't. The definition is broad. When it comes to ETFs, the common sentiment is why bet on individual stocks when you can bet on the growth of America itself? And it does make some sense, but I'd rather bet on myself. I want my money to work the same way I do. Smart. That's kind of what this channel is about, and probably why you're watching this video. You might be thinking, that's easy for you to say. You know stuff, and we don't. That's fine. It's a process, and you're gonna get there. So what do you do now? The first thing you need to do is smash the like button. But seriously, to grow money, you need money. The most important thing you need at first is a risk fund. This is money that you don't need to tap into to pay for bills, tuition, drinks, or emergencies. When you do this, you remove fear from the equation, and when fear is gone, logic prevails. Neil can give you some practical advice on how to do this. So you have some money. Now what? You need to seek out and identify your informational advantage. An informational advantage is the information you have that others don't. Back to our small town. Maybe you understand the supply chain logistics of grocery store chains very well and have a few friends in the industry. Maybe you understand that rising oil prices are causing an increase in transportation costs, and that, according to your friends, these costs are materially affecting the supply chain logistics of your local mega grocer. This in turn is resulting in a slight but noticeable increase in the price of milk. Because of this, you think that local corner stores are going to see more business. People aren't going to drive out to the mega grocer if they're not going to save any money. So what do? You invest in corner stores. In this scenario, the tip-off from your friends is your informational advantage. You're leveraging this with your understanding of corner stores to gain the upper hand in the market. The general market doesn't know what you do. They don't have your friends, and they just don't understand corner stores. That's why you believe that the true value of the business is higher than it's currently priced. This is your opportunity. Now, I won't get much more into informational advantages here. It's a vast topic and we'll cover it in subsequent videos. If you want to tune in for that, just hit the subscribe button and the notification bell. We'll let you know when the video comes out. So we've learned a lot today. We've learned that diversification isn't the silver bullet that everyone makes it out to be. We talked a little bit about how diversification can make sense, but we also talked about the merits of portfolio concentration. At the end of the day, if you want to make real money, you need to take a bet on yourself. Seek out informational advantages and combine them with the things you know in order to find market discrepancies. This is your opportunity. If you found this video useful, smash the like button. And if you have any questions or ideas, just share them in the comments below. We're going to cover a lot more, so if you don't want to miss out, make sure you're subscribed. Stay healthy, stay happy, and I'll talk to you guys soon.